The Chinese stock market has gone absolutely berserk. The CSI300 Shanghai index is now up almost 30% from its February trough, resulting in almost 25% positive gains just over the past 5 trading days. That, folks, is unheard of, not just for individual stocks, but for indices that contain over 300 of those same stocks. This blistering rally in Chinese stocks comes after a 3-year stint of massive underperformance in companies, stocks, and even the economy in mainland China, and comes off of last week's most aggressive stimulus measures announced by Beijing since 2020. And particularly what's exciting here is that the bull market has officially begun after years of pain and lack of investor confidence. And yes, this chart looks just as hilarious as any meme stock would seem today in 2024. In a bid to save its property sector and aging population spurred by a lack of job opportunity for its youth, China has come out with the best of best measures to secure its position as a technology leader. Just a few weeks after the Fed in the United States cut its benchmark interest rates by 50 basis points, a shock to investors and analysts even in the United States, China has followed suit, clearly following in the footsteps of the world's greatest economy. The reason why this is important is because China needed validation from the world's biggest dollar reserve currency that it would make sense for them themselves to lower their interest rates and spur economic output. Something like this being announced by a government is insanity, but it's an important step in a time when the US, because the reality is that China is trading extremely cheaply in at least the CSI 300. Compared to the S&P 500 since the pandemic, the price to forward earnings ratio has absolutely collapsed. Many attribute this to the regime, but regardless of what kind of political or non-political effects has pushed this down, the reality is there's always a reversion to the mean. And since right now, policy from the Fed is starting to U-turn, so is the Chinese government. And what's yet another thing driving this insane rally in the market? The idea that less than 10% of citizens in China actually own stock, unlike 70% of people in the United States. And this is something that needs changing soon. Unlike in the United States, which is pretty focused on 401ks, retirement plans, and grants that are focused on equities, China, being the regime that it is, has none of that. So most people in China don't own stocks at all, meaning most of the trading and volatility taking place in those markets are from hedge funds, managers, and capitalists, mostly outside of China, particularly in Hong Kong. And it's those same people that have had cash sitting in record amounts since interest rates have been so high for the past 2.5 years. And well, what happens to be one of the only global equity markets that is trading at a 52-week low, not to mention most likely a 5-year low, well, it's China. And that is where investors see a return for their money right now. Now, whether or not these policy changes will affect the Chinese consumer and improve economic data, only time will tell. Because the reality is, since most people don't own stocks, a benefit in the stock market isn't going to spur economic growth. But one thing's for certain. This shift we're seeing in sentiment is something that's not going to just last for a few months. There's a high chance this is a seismic and fundamental shift in the image of Chinese equities, which have been destroyed in the West at least. As with everything in the stock market, remember that markets are always leading indicators, not lagging indicators. Meaning what's happening right now is most likely going to get reflected in economic data maybe a few quarters from today. And investors are simply pricing in the effects of all these stimulus economic policies having on the consumer, GDP growth, as well as the property sector. And what's more is that this is going to have different performance results and different effects for different types of Chinese stocks. The ones that are traded on the Hong Kong index, like Alibaba, for example, had a red day today, even though the CSI300 was up almost 8%. That's because the CSI is for mainland stocks in Shanghai, whereas Alibaba and other startups like Xpeng and Neo are trading on the Hong Kong indices. But as usual, folks, that is just my take on the situation, so let me know your thoughts on China's new bull market down in the comments section below. Thanks a lot for watching, folks, and I'll catch you guys in the next one. Take care.